Ladies and gentlemen, welcome to this week's version of Nichols and Nimes, our weekly video series. The quote of the week this week comes from a very famous money manager called Paul Tudor Jones, often written about in financial press. Paul says, don't focus on making money, focus on protecting what you have. Don't focus on making money, focus on protecting what you have. One of the keys to protecting what you have is by implementing effective strategies to protect your money from down financial markets. We've had, over the history of the markets, we've had some bad or very negative financial markets. For example, most recently in 2008, we had the financial crisis. Prior to that, we had the dot-com bust from 2000 to 2002. So the question to you is, do you have an effective strategy to protect your money from down financial markets? Many people don't. Now, there are multiple strategies. For example, you could raise cash if you're in equities, i.e. sell stock and sit in cash and ride it out. It's very difficult to time the market. But another strategy that many money managers implement is implementing put options. A put option is a contract that allows an investor to sell an investment at a certain price at a certain point in time. I'm going to switch this video to a quick video I did at some point in the recent past that explains how put options work mathematically, and I'll be right back with you. Stay tuned. Put options allow an investor to sell an underlying investment for a certain price at a certain point in time. The benefit to you is that you now have control over the price you want to sell an investment, so you limit your losses to a certain dollar amount. You know the exact amount you can lose. So let me give you a simplified example showing the result of using put options in our investment protection plan. Let's say investor 1 in an unprotected investment account bought 20,000 shares of ABC stock at $50 per share for a $1 million investment. So $50 per share times 20,000 shares equal $1 million in market value. Let's also assume that we had another downturn in the market like we saw in 2008, and that sometime after purchase, ABC stock declined from $50 a share to $30 a share, or 40%, resulting in the investment account declining to $600,000. That's a loss of $400,000. Now, let's look at investor 2, using a put option strategy available in the investment protection plan. They bought the same 20,000 shares of ABC stock at $50 per share, a $1 million total investment. But the difference is they also bought a put option that gave them the right to sell ABC stock at $45 a share, resulting in the investment account declining 10%, or to $900,000. Investor 2's purchase of the put option saved them $300,000, less the price of the option contract. Now, I should note that sometimes option contracts can be expensive, but we figured out a way to offset these costs and operate these contracts most efficiently. Welcome back. I assume that was, at least on an oversimplified basis, a very clear explanation how put option works, again, using some simple math. To that end, one of the questions you have for yourself is, do you have an effective strategy to protect yourself against a bad market? Put options may be something to consider. To that end, if you would like a second opinion on your portfolio or financial situation, you could send me an email, cnichols@nicholswealth.com, or go on our website at nicholswealth.com to learn more. In the meantime, ask yourself, do I have an effective plan in place to protect my money, my portfolio against the bad market? Many people I found out do not. Do you? Have a great day. Bye-bye.